Good afternoon, everyone. Thank you for joining us. Welcome to the first dialogue series of the year. I'm Anjal from the AASB. The dialogue series is held jointly with CPA and CANZ, and the purpose of the dialogue series is to gather preparers, users, auditors, and other stakeholders to come together, share their views, and learn from each other. The topic for today is connectivity and boundaries of annual reporting, and this session will be chaired by AASB Research Director, Dr. Eric Lee. Please note that the views shared in this session are not the views of the presenter's organization, but their personal view. Also, you can ask us any questions using the Q&A function in Zoom, and we will try to answer as many questions as time allows. With that, I'll hand the session over to Eric.
Thank you, Angel. Good afternoon, everyone. Welcome to our first dialogue series session of the year. Today, we're going to explore the topic of connectivity and the boundaries of annual reporting. Now, I'm not going to lie, it is an interesting but also very big topic to discuss. Now, there is the growing expectation from different users, including different types of investors, for entities to disclose more information and consider that information in the financial thinking, decision making. And there have been many discussions about the connectivity of various forms of non-financial information that are sitting in different places in the annual reports and the financial information. Now, many stakeholders may be confused about how much information, include other forms of non-financial information, should be reported by entities in the annual reports. But we also need to be mindful that this topic isn't new. For example, one of the reasons for having the conceptual framework in the accounting standards is to set boundaries of the general purpose financial statements and make sure information is connected to meet user needs. And many years ago, there was this awareness that entities provided a substantial amount of information in the annual reports, and many of them were overlapping information disclosures, and many entities then went through a phase of streamlining the financial reports so that they could be more readable and connected. Well, lately there also has been an increasing demand for sustainability information. This adds a layer of complication. So in this session, we will hear perspectives on this topic. With me today, first, I'd like to introduce Jade from University of Melbourne. Jade just completed her honours degree, and she's going to start her PhD program in accounting. So Jade, I'm going to hand this session to you. Tell us about your research, what you have learned from your research, in particular about whether location matters for preparers when you think about disclosing information to meet user needs.
100%. Thank you so much, Eric. And would it be okay if I start sharing screen for my presentation?
Go for it.
Sounds great. Please let me know if you guys can see my screen. Yeah, wonderful. First of all, thank you to everyone who has come to this presentation as well as dialogue series today. It's genuinely so great to see that a lot of people are interested in connected information as well as connectivity, because it is something that's very, very interesting, both in research and practice. And we do have some really interesting stories as well as results to tell. But to begin, I'd like to thank my supervisors as well as colleagues from the University of Melbourne, Michael as well as Brad, for obviously helping me so much with this thesis. And we're also trying to turn this into a paper. So essentially what we did during this paper is we explored the relevance of sustainability information in financial reporting whilst taking on the angle of an investor's perspective, so primarily the users. Regarding our key research questions, so to basically summarize this, what we investigated is under what circumstances would investors find sustainability information to be more relevant for their decision-making? And we tried to look at this under two different aspects, which is whether sustainability information can be more meaningfully connected with financial information in an entity's financial reports, as well as whether quantification of sustainability information would actually also influence the relevance of the sustainability information. I think naturally what we would think about is, why do these questions actually matter? And as I'm sure a lot of us may already know, there are a lot of recent developments currently in the sustainability reporting landscape. And in particular, we do have the IFRS 1 and IFRS 2, which are the disclosure standards proposed by the AASB, which mandates the disclosure of sustainability-related financial information and climate-related financial information in an entity's financial reports. And although we also do see this, and we also see that the SEC has also adopted a lot of climate-related disclosure rules in recent times, what we do currently miss, as well as in practice and research, is that these standards are not quite prescriptive, or they're quite high level in nature as well. So what we actually identify is that at the moment, they do not provide as much guidance as possible regarding to how entities should exactly present or disclose the sustainability related information. And coupled with that is the concept of connected information that's also introduced within IFRS 1. Although there are examples that we'll also be able to see later on in the presentation, we also do notice that those examples are quite high level and principles based, which again adds to that layer of complexity that Eric has just mentioned regarding how exactly should we present the sustainability information in our financial reports. And at the same time, something that has arisen in prior literature as well as practice is that we do see a rising presence of both qualitative and quantitative sustainability disclosures. Although prior literature has typically associated sustainability information to be more qualitative in nature, we do see a rising presence of quantitative disclosures in the form of, for example, scenario analyses, as well as forecasts of emissions, etc. So something really interesting that we propose as well as want to investigate was whether this rising presence of qualitative and quantitative information will also interact with the fact that entities do have the capability as well as the opportunity to be able to make more meaningful linkages with their sustainability and financial information, and whether overall this would have an impact on how investors perceive sustainability information and its relevance. So before moving on to our formal proposition as well as results, I do want to go through basically what we know currently about connected information as well as quantification of sustainability information. The AASB has proposed IFRS 1, which has provided some connected information examples that we're able to see. So on the slide we have here is, for example, different examples ranging from how climate-related risks may affect contingent liabilities as well as impairments of a company, but at the same time also expanding to how sustainability opportunities can affect an entity's future revenue streams. So as we can see from these examples, they're quite high level and more broad in nature, and this leaves a lot of managerial discretion to being up to the management to be able to disclose the sustainability information in accordance with these sorts of examples and what they think is also relevant to disclose. But at the same time, what we also notice is there isn't really a lot of guidance in terms of how exactly should we present these sorts of information in an entity's financial reports. And at the same time, just coupled with the connected information examples that we're able to see, these increased opportunities to be able to quantify those sustainability disclosures, especially given this rising presence, as well as increase in the use of scenario analyses, as well as disclosures on emission scopes 1, 2, and 3, and more, could essentially interact with these connected information to essentially facilitate more relevant information that the entities are able to disclose and that investors would also be finding relevant for their decision making. In general, our proposition was that by connecting information, by connecting sustainability and financial information and facilitating those really meaningful linkages, as well as quantifying the sustainability information, will ultimately increase the sustainability information's relevance. Something else that we had also thought about as well as investigated is how exactly do we measure relevance and what does relevant information actually entail? We adopted the approach suggested by the conceptual framework, which defines relevant information as information that is capable to make a difference in the decisions made by users, and in our context, there would be investors. So ultimately, our experimental setup in order to measure the relevance of sustainability information perceived by investors is as follows. We essentially sourced 320 experienced investors who completed a risk review of a hypothetical company with a prospective risk event attached. And what we provided those investors was two extracts, which is one sustainability report extract and a financial report extract. And essentially what we we manipulated was whether information was more or less connected, whether the information was quantified, and exactly how likely was the sustainability risk going to be for them. In terms of more or less connected information, we had more connected information as embedding the risk event in both the sustainability and financial report extract, whereas less connected information only indicated that the information was only available in the sustainability report extract. For quantification, we manipulated whether the risk event was presented verbally or numerically as a percentage to our investors. And for the likelihood of the sustainability risk, that was also something that we'd manipulated as high or low, as something we had discovered during our literary review was that essentially, intuitively, it would be quite intuitive for investors to essentially perceive a sustainability risk that has a higher likelihood of occurring to be more relevant for their decision-making and investment decisions. So moving on to some of our results, we ultimately found that sustainability information is seen as more relevant, especially when the risk event has a high likelihood of occurring and the information is connected, regardless of quantification. However, how those different variables interact together to drive relevance is a lot more complex than what we had expected, actually. So I'll go through the plots one by one, starting from the left-hand side. On the left-hand side, we can see we measure the relevance of sustainability information when the risk event has a low likelihood of occurring, and we have the y-axis as the relevance of the sustainability information as seen by investors, and the y-axis as whether the information was more or less connected. What we're able to observe is that the quantified sustainability information is seen to be more relevant when the event has a low likelihood of occurring, as we can see in the low likelihood scenario, and the information is more connected. And that's where quantification makes a really big difference. However, and this is something very interesting, at the same time, something we're also trying to figure out for ourselves at the moment, is that when we look at the plot on the right-hand side, for when the sustainability risk has a more high likelihood chance or higher chance of occurring, we see that the quantified sustainability information is also seen as more relevant when the event has a high likelihood of occurring and the information is actually disconnected, as we can see from the significant difference between if information is presented quantitatively or qualitatively when connectivity or connected information, there is less connected information. So what this actually tells us is that there are a lot more complexities in how these variables interact together to essentially drive the relevance of sustainability information. But something that we're initially able to conclude was that by presenting information qualitatively, there's actually a lot more different interpretations going on that we had anticipated, as we can see from the different slopes, and especially if we look at the slope of the quantitative way of presenting sustainability information, they're quite constant in whether the sustainability information has a sustainability risk event has a low or high likelihood of occurring. So at the end of the day, what we really wanted to just say from our results and what we can conclude from our results is that quantification does matter. And it's very important for different standard setters as well as preparers to recognize that and how that impacts the relevance of sustainability information as seen by investors. So some key takeaways. Obviously, again, I just want to emphasize that it's very complex because we have connected information, we have quantification and the likelihood of the risk event all interacting together to drive the likelihood, to drive the relevance of the sustainability information as perceived by investors. And it definitely would be a really long journey before we do reach a really big common ground, first of all, to essentially agree on what connected information is. And I think our panelists would later also provide some really nice and detailed discussion on what these boundaries as well as connected information can potentially entail. But before I conclude my presentation and pass it back to Eric, I'd also like to give a really big special thanks to Glenn Brady from EY, because throughout my internship there, I was able to speak with him and also gather a lot of his thoughts on this topic. And a lot of this wouldn't have been possible without him as well. But thank you so much, everyone. And I'll just pass it back to Eric.
Thanks, Jade, for sharing your research. And there's some really interesting findings there that we can discuss it through the panel discussion later. But let me first introduce our panelists today. First up, I'd like to first introduce Rebecca Morgan, who is with us right now, and she's been working for more than 20 years in the property industry with roles at EY, Dexus, New City, which is based in Japan, and Rawson Homes as CFO. And before her current role, she was a head of finance at GPT. And in her current role right now, she oversees the group finance, asset finance, and shared services functions, as well as a team who work on process improvements and system implementations. She is a fellow of CAANZ, and she is also the chair of the Property Council of Australia Accounting Committee and a member of AASB Disclosure Initiative Advisory Committee. Welcome, Rebecca. I'd like to also now introduce Siva Nantham, who's Director of the Accounting Policy Group at the Department of Treasury and Finance, Victoria. He has a lot of experience not only in the public sector space, but also in the for-profit space. So today we'll be hearing from Siva, providing us some complication in this topic in the public sector perspective. And then Lou Caparelli, who is the head of ESG at this UniSuper Management Proprietary Limited, with the responsibility for UniSuper's environmental, social, and governance approach in investments. Lou joined UniSuper in July 2015 as a manager, equities covering a range of domestic and international stocks. He was appointed in 2018 as co-manager of the Sustainable Australian Equities portfolio. In 2019, he joined the ESG team and was appointed head of ESG in July 2022. Lou also is the AASB's Users Committee member, and he's been very active in providing perspective from the users' experience for standard setting. Welcome, Lou. And then I'd also like to introduce Anne Waters, who I think many of us are familiar with, because Anne is working with the AASB, and we work with the AASB very closely. Anne is a Deputy Technical Director for the AASB and responsible to research development and the delivery of Australian auditing standards as part of the AASB's strategy. And the next one I want to introduce is Lynn, who is from the UWA Business School. She is the senior lecturer there, and she's also the chair of the CANZ Sustainability Working Group in Western Australia. That she promotes the integration of sustainability principles and practices into organizational behavior. So with that, I would like to first hand the next short presentations to Lindy, because I'm aware that Lindy published an article about the boundaries of reporting. So Lindy, can I hand the session over to you? Would you mind to share your slides as well?
Thanks, Eric. Lovely to be here. Okay, so let's think about big global listed companies and think about their annual reports, those fat annual reports, 200, 300 pages. So we've got the back half, which is the financial statements with the notes, and then we've got the front half. And there we've got the management commentary. These days we've got sustainability reporting sections, climate sections. We've got other parts in the front half. So if we just look at that annual report as a whole, this paper started in 2018 before things got exciting globally in the sustainability reporting space. And at the time, I was looking at these large annual reports, and I was thinking about this, what are the boundaries? Like, who's the report for? And I was thinking about the influence, because we were having sustainability reporting in the front half, we've got the financial statements in the back half. Who is the target audience? We're being influenced by the GRI, we're being influenced by the AASB, but everyone's housed in that same report. So that got me thinking at that point about what a boundary is. Now, we use boundaries in other instances, such as trying to draw a line around your country or distinguishing one business from another or one discipline from another. So in the reporting context, what this paper set about to do is to determine a set of rules or a basis for helping us determine which entities, transactions, activities, and impacts are included in a boundary. Because at the time, all the standard setters were getting involved, and I could see that all the different standard setters, the GRI, at the time, the EU, AASB at the time, they were busy developing the new management commentary guidance. Everyone was having slightly different underlying premises. So I was trying to think, what is the set of rules that together can give us clarity of that boundary? So if you look in blue there, that was what this paper was about. It was trying to look at previous industry and academic literature and trying to understand, what do we all need to know to have a clear boundary about what a report is all about? And then, how do the different standard setters at the time, because they were changing all the time, they were changing and updating at the time around 2018 to 2021, where do those different standard setters sit within those different rules or boundaries? Like, did they agree? Were they taking an investor focus, or were they taking a broader stakeholder focus? So what this is, why it's important, is because also some of the standard setters that actually have merged subsequently, like the Value Reporting Foundation and the IFRS trustees, etc., some of their original premises and boundary definitions were slightly different, but it has been interesting to see how the different standard setters who have joined forces have sort of agreed on their new boundaries for how people should think about reporting using their guidelines. So the findings of this paper led us to 10 key boundary dimensions. And the idea is that any standard setter needs to be very clear to us, preparers or users, about what those boundary dimensions are for us to interpret and prepare these annual reports. So at the time, these were the documents, the standard setting documents that were there at the time. It has changed. So we looked at the IFRS accounting and the IFRS Foundation consultation paper, the TCFD, the FRC at the time, AASB, IIRC, EU Commission, and GRI. So at the time, those were all the different standard setters. We know that there's been a lot of shifting and amalgamation since then. So this is what the paper found. Okay, so number one sounds obvious, but it's not. Who is the reporting entity for the annual report? Now, us accountants have spent a long time working out who a group is and how to account for group transactions. So all of us know that when we read the financial statements and we read revenue, we know that that's the group's revenue, and we understand what happened to the intercompany sales, etc. But the problem at the time was, I was reading the financial statements, but then I was looking at the front half, and it seemed like the boundary was going all over the place. Sometimes people would report on, for example, minimum wages in the front half, but they'll only talk about the head office in the USA, but they wouldn't talk about their suppliers in other countries. So it was, you telling me about part of your entity. It's kind of like in the financial statements, we wouldn't just tell you, oh, we're telling you about revenue in one of our companies in the group, but not everyone. So the reporting entity, number one, is really important to understand. And I mean, the greenhouse gas protocol I was reading in their update from, they're trying to update the standard. And they were saying they're thinking of potentially making the organizational boundary for greenhouse gas reporting more similar, or hopefully the same, as the financial entity concept. Because what worries me even now is we know how important greenhouse gas accounting is, but we're comparing the financials that deal with the group companies. But as far as the greenhouse gas emissions that we're reporting often in the front half of an annual report, that might be based on operational control, which means we might not even be reporting on the greenhouse gas emissions relating to the companies that we're actually covering in our financial statements, which to me is a huge mismatch. And because the greenhouse gas protocol has got different ways of defining the organizational boundary at the moment, two companies, could use either financial or operational control, etc. Okay, so number one is really important. Number two, our target users. So of course we know that luckily the AASB and the ISSB, we've got the one conceptual framework. So we focused on the providers of capital. But what also is happening is if our companies are also using GRI, for example, for their sustainability reporting and reporting some of that in the front half, then some of those statements have a wider stakeholder focus. So again, these are just any standard setter needs to let us know who are we targeting, for us to know what to put into our reports and how to interpret our reports. And also to give a complete picture so that people can't just talk about a couple of different companies in their group. They need to give us the sustainability information about more holistically, or at least tell us why they're not giving us the information about other parts of the group, but focusing on potentially the material companies reporting. Like, for example, with sustainability, perhaps the minimum wage is a very big issue in one part of the group. So then it might make sense for them to report on the management in that part of the group. But the problem is what I was seeing in the in the annual report was actually that they'd be talking about the good things happening maybe at head office with the minimum wage, but then they were neglecting to tell us what was going on in other parts of the group. So number three has, subsequent to this paper, become a very hot topic. And that's basically the financial versus impact versus double materiality debate, which is also important for people to define. The boundary description. So some of the standard setters that we were analyzing, some describe the boundary for the whole entity, like who's in the group, but then the GRI takes a topic boundary because they actually, when they put together their disclosure on a particular topic, they say for every topic, if you're talking about minimum wage, you need to say, well, this is the minimum wage for the US or for Indonesia. So I think some standard setters aren't very clear about that. Number five is whether we look at the outward or the inward towards the company impact, which is very similar to the materiality debate. And then number six is very important because some standard setters look at the company and others look at the supply chain more generally. So it's important for standard setters to decide, what is the boundary? Are we going supply chain or not? And then we have the time and the type of performance and the value. So at the time we had, for example, the integrated reporting framework focusing on value, but is it value for the entity or is it wider stakeholder value like the GRI has in their standards? And the final one that we need to know is the purpose of that report, which all the different standard setters define the purpose of the reports they advocate. So those were the 10 boundary dimensions. And thinking about connectivity, if we're talking about an organization we can see that it's important that the whole annual report fits together and appears to give us a holistic story of that organization, and that in the front half and back half that we're talking about the same entity and covering the same group companies. And with the new sustainability reporting that might be mandatory in the front half, it's important, for example, that if there's risk relating to climate, that we see how and why or why not that risk features in our actual financial statements as well, to provide that cohesion and connectivity. So I'm going to hand back to Eric, because I think we've got a lot more to talk about connectivity. Thank you very much, Eric.
No, thanks, Lindy. I think that's a great introduction on how complex it is when we think about boundaries of annual reporting. And so everyone, if you have any questions, feel free to put your question in the Q&A function. We'll try our best to also address your questions during this session. So with that introduction from Jade and Lindy, I'd like to actually ask Rebecca, who's a preparer, from the preparer's perspective on this question. Now, as we heard from Lindy, boundaries are so difficult to conceptualize, but we know that it's important to think about it, because without knowing the boundaries, that is the purpose of reporting, it's actually hard to also understand the connectivity piece, right? So from your perspective, Rebecca, as a preparer, can you give us some insights on how do you decide what information to disclose where in the annual reporting, and given there's so much information out there you're going to have to disclose to meet user needs, and how do you define the boundaries of your annual reporting?
Actually, as Lindy was giving her presentation, I was smiling away to myself, because it is actually a big challenge that we face. Probably less so in the financial reporting space, because to Lindy's point, I think that the literature and the regulations are a lot more defined in relation to financial reporting, but certainly in terms of sustainability information, I think it's a big challenge for us. And the current way that we report on our sustainability information probably isn't going to be fit for purpose when the ISSBs are released. I'm not even sure that the ISSBs themselves, or the Australian equivalents thereof that are currently being released, actually really have answered that question. So just to give a bit of background, GPT is a manager of real estate assets, and we manage assets on our own behalf and also on behalf of funds, and they have different investor groups. So we can draw a boundary around GPT as an asset owner, or we can say, to Lindy's point, that we actually have control from a sustainability perspective over a larger number of assets. So we control the sustainability outcomes of all the assets that we manage on behalf of our other investor groups, not just those people who directly invest in GPT. At the moment, we have two quite distinct reports. So we have a financial report, which is an integrated report, and so does have some sustainability information in there. But because we also try and meet TNFD and TCFD requirements, we have a separate climate and nature disclosure statement, which is released around the same time as our annual report, just slightly after. So in terms of the ISSBs coming in, it's easy for us to say, well, we're really far progressed with our TCFD reporting, we're in good shape. But in actual fact, the boundaries for the ISSB reporting are quite different. So suddenly we're going to have to segment our climate and nature disclosure statement by reporting entity, because at the moment the ISSBs are sort of drafted along the lines of what reporting entity does this information relate to. So at the moment, our statement covers everything that we manage. And that's just for the climate and nature disclosure. Obviously, the financial reports are by reporting entity. And we only do integrated as well for our main listed GPT product. And even that tends to refer back to a broader range of sustainability outcomes, as opposed to just what is owned directly by GPT. So we're actually going through a process now of actually trying to pull that apart and say, for our climate and nature disclosure statement, because we are still thinking that it will be a separate report even under the ISSBs, we'll just release it together with our annual report to start with. then how do we then go and draw a circle around just an individual entity and report just on that entity? And the one thing that I'm waiting on an answer from any of the regulators, if anybody's online, is what do you do with equity accounted vehicles? Because I actually don't know how to treat them under the AASBs. I don't know, how they are intended to roll up into that structure, and I don't think that anyone's clear at this point in time.
Sounds like there are a bit of still a lot of concerns and preparations need to do with with this space. So perhaps Lou can give us a bit of insight on this, given that you're head of ESG and as an investor's perspective, and understanding that many preparers are now on the way on providing those information for meeting your needs, Lou. Maybe take one step back a bit. In the last recent years, did you see entities have been improving with the connectiveness in the annual reports? Are there things that they can improve on? Do you see that? Are there any informations you don't see that's been reporting at the moment?
Thanks, Eric. I guess from my perspective, this concept of connectivity is something that we are living like in a way. So at UniSuper, our investments team is integrated with ESG. So although my team are the subject matter experts on ESG, all of the investment team, portfolio managers, our CIO and analysts have responsibility for ESG. And so we all work pretty closely together. And what I will say is that sustainability reporting at the top sort of 50 or 100 companies has gotten materially better. Like I noted Rebecca's comments earlier, like I would be staggered if GPT's reporting suite doesn't already well and truly clear the bar for TSC, TCFD, IAASB, whatever sustainability acronym is going to get thrown at us in due course. But in some ways, so it should. It's a top 50 ASX listed company, and it will have the resources to do that. We are extensive users of that information, and we have regular engagements with the sustainability teams of our key holdings. I was, the reason I didn't get on as early as you wanted me to, Eric, is that I was just wrapping up a sustainability engagement with another of our large ASX holdings. So because we're in a position of privilege where we do get this level of access and have some influence over companies in terms of what we would like to see, we find that the companies are quite responsive to what we'd like to see. And particularly around climate reporting, that is an area of huge focus for us. We produce an annual climate report where we assess our view on how good is not the climate reporting, but the approach to climate more broadly of our top 50 Australian holdings. This is a public document. People are free to look at it and download it if they wish. And part of that means that we have to rely on the disclosures of our key holdings to get that information. But we've found, in our engagements with companies, that the companies themselves, and GPT is an example of this, are very keen to provide whatever information is useful to us. One of the difficulties we're having in this period is that where it's all pretty nascent, is that in the absence of sort of prescriptive standards, it has been something of a choose your own adventure for what companies report. But I participate and my team participate in a lot of these materiality assessments with companies, and they get external parties to help them in some cases. What are the things you're interested in? The companies normally have a pretty good idea of what are the sustainability issues that they think are of interest to to their stakeholders, including their investors. We will often be asked, give us a ranking of what you think are the most important ones here. We can volunteer our own. But on the concept of sort of integrated versus separate sustainability reporting, that I'm often asked that question and I never quite know how to answer it, because it seems to me an issue of form over substance. I don't really care where it's disclosed as long as it is disclosed. It does make sense in an annual reporting suite to have some sort of extract, executive summary of what's in the deeper sustainability reporting. But we are in a sort of good position. But I do acknowledge, though, that this is more ASX 50, ASX 100 sort of centric view. And, I've had a lot of companies outside the top 100 freaking out about the upcoming mandatory sustainability reporting standards because they don't have the resources to be able to do it to the right standard. And just on that other concept of choosing your own adventure, like I applaud the fact that we're now building towards mandatory reporting and a bit more sort of prescriptiveness, if that's a word, on this. But I do think it's also legitimate that companies do be permitted to choose their own adventure. Like I do marvel at some companies talking about what they're doing on climate and what their emissions are, and like if they're a services company, it's like a non-issue. I don't want to say it's a non-issue because if there's any UniSuper members who are activists here, they're going to get upset at me. But they're not the companies that are going to solve the climate crisis. But what's important for those companies could be, for example, take a Seek, the online jobs board. What's important for them is their management of data, right? So we look at ESG issues across the entire spectrum of E and S and G. There's been a sort of excessive, almost manic focus on issues of E and in particular C and D, namely climate and decarbonisation. But they're not always the most relevant issues for companies, and companies do have to pick and choose what are the right ones. Now, I contrast that with the financial reporting, and in a million years, I would never want companies to choose their own adventures on how to report that. Plenty of companies do, but at least they're held accountable to produce what's in the traditional accounting standards. But in the case of sustainability reporting, because it is so broad an area to cover, and because the issues differ by company, I do think that any sort of mandatory reporting regime is going to have to be a lot more principles-based and a lot less sort of prescriptive, you must do this, you must do that, but just, address the issues of what are relevant for investors. And if you don't know, find out. Anyway, I think I'll climb down off my soapbox after that.
No, thanks, Lou. But I like your point by saying that, companies tend to choose their own adventure. Rebecca, can I come back to you with that, follow up with you with that question? So Lou mentioned that there are a lot of stakeholders that entities will need to consider when providing such information. How do you determine meeting all these stakeholders' needs?
Yeah, I mean, I think that the financial disclosure requirements are quite prescriptive in terms of, that's investor based. So, and you go beyond your traditional equity investors, that would include debt investors as well. But certainly they would be our primary focus, even on our current sustainability reporting. So first and foremost, I think it's for them. I mean, we operate a lot of shopping centres, so I understand that there are users that, a wide range of community users that may be impacted. The chances of them finding their way to my financial statements, though, are not that high, I would say, unless, or my climate disclosure statement, unless there was a particular issue and there was an activist in that space. So I think first and foremost, our main consideration is investors.
Okay, No, thanks, Rebecca. So now I'm going to turn our mind to the public sector, which is another layer of complication. So Rebecca mentioned that for the for-profit entities, they focus on the investors as the primary users. For the public sectors, though, Siva, can you give us a bit of insight? How do you determine the boundaries of your the financial reports? Who are the users and who are the stakeholders?
Thank you, Eric. And I think that's a great question, and I can spend a lot of time going through it, but I'll try to keep it as concise as possible. As you would expect in the public sector context, in addition to our lenders and credit providers, etc., we have a wide range of users. That includes members of parliament, taxpayers, donors, and people who are recipients of our services. And that practically means a lot of additional information gets reported in our annual reports. So in terms of the boundary and where that information goes and where it gets reported, a lot of the times it's driven by government policy as reflected in our reporting directions. For example, in Victoria, we have Victorian Financial Reporting Directions that deals with financial reporting as well as non-financial reporting matters. As sort of Rebecca touched on, a lot of the financial reporting side of things are pretty tight and already built into the requirements. With respect to non-financial reporting, there is often judgment and practice varies depending on where that requirement arises. For example, some of our requirements we have come from an audit office performance audit recommendation to report on some certain additional information. There might be some requirements coming from our PAC, which is our Public Accounts and Estimates Committee, making certain recommendations of additional information going in. So if you look at a typical set of public sector financial report, particularly the Victorian ones, you will see the report of operations and the part outside of the financial report, including a whole range of things, including government advertising, emergency procurement, use of consultants and contractors, environmental reporting, major contracts, and the list goes on. So in terms of where that is reported, again, that practice varies from jurisdiction to jurisdiction. If I take the item consultants versus contractors as an example, again, in the public sector sense, there is a lot of focus in terms of how much money the government spends on contractors and consultants and what role the consultancies play in terms of government decision making. So it is subject to a lot of focus and a lot of attention. In terms of how we report in Victoria, for example, within our report of operations, we will report anything greater than 10K in terms of those consultancy type ones, not really the labor hire ones. And some of the additional information would be required to be held by entities for on-demand requests. So people can demand that additional information through freedom of information and other requests. So not everything that people may need go into the annual report, but some of the critical information goes in. If you look at the same topic in other jurisdictions, for example, in WA, you won't see any of that in their annual reports because they produce a separate biannual report for the whole of government in terms of where the consultancy spend goes. And if you look at Queensland, for example, somewhat similar, but they have a central database whereby they make it available for people to access through the procurement process. And if you look at Commonwealth, they have a hybrid approach where they include a summarized information on the annual report with the tender database and a central database providing a lot more detailed information. So the practice varies, and a lot of the times it's a jurisdictional policy decisions as to where that information goes. Now, in terms of the linkage between financial report and the annual report and other components, one of the other big things in the public sector is the budget. The state budget, for example, in our case, is a public document. All of our budget papers are public documents. And the budget papers and the budget includes our estimated financial information for the budget period as well as 3 or 4 forward years. And that goes through an assurance process, which is pretty unique in Victoria, where the Auditor General's office goes through a limited review process to give some comfort. So a lot of reliance placed on that budget reporting as some form of annual report too. So if you look at our annual reports, a lot of the times you will see that budget versus actual analysis, the variance, output performance measures, reporting, etc. So while the budget is a separate piece, you will see annual report pretty much accruing against budget and reporting a lot of additional information that you wouldn't otherwise see. So I think that's a pretty unique in some way to the public sector. The other thing that I wanted to touch on is, given this broader theme and a lot of other non-financial information we provide, the connectivity in some way is not restricted to what's within the annual report, but it's also what's outside the annual report. For example, I said, budget, etc. But having said that, this is not unique for public sector. If you look at listed companies, for example, they have remuneration reports, which it's within the director's report, but that is subject to audit. If you look at the remuneration report, that connects with the relevant notes in the financial report to, say, KMP disclosures or your share-based payments, etc. Similarly, listed companies provide corporate governance statements, and there is a choice to include it within the annual report or have it as a separate website presentation with a hyperlink provided in your annual report. So in some way it's similar, but it's somewhat of a different beast, Eric. Yeah.
Okay. Now, thanks for sharing some of the public sector's perspective insights. I'm going to turn my mind now to audits and you're online. Yes. So can you please give us some insights from the auditing perspective, whether there's any challenges of auditing or giving assurance to this sustainability information or the connectiveness of the information?
Yeah. So thanks, Eric. So I suppose just upfront, the auditor's responsibilities at the moment, that is a statutory responsibility, is to audit the financial statements. So the financial statements are prepared in accordance with the accounting standards. Depending on the entity, there will be sustainability information in the financial statements, depending on the impact on the entity. But the auditor provides reasonable assurance over the financial statements. The auditor also, at the moment, is responsible for considering other information. So that's information that's reported in the annual report that is not subject to audit. However, the auditor does read the other information to consider whether it's consistent with the audited financial statements and with their understanding of the entity. So that's the auditor giving some, so it's not assurance, but they are considering whether we use the word connectivity or whether we use the word consistency around what's been audited and other information that's being reported alongside that audited information. So at the moment, the auditor has that responsibility and has had it for a number of, for a number of years. As sustainability information is being reported more and more, and as we're preparing for mandatory climate reporting in a sustainability report, the auditor, when they're auditing the financial statements, will be considering that sustainability report will be other information to the financial statement auditor. So once again, they'll be looking at it to see, is there anything that's inconsistent with the financial statements? And so that will impact areas such as accounting estimates, etc. If they're saying in their sustainability report that they've got a risk or an opportunity in relation to climate, has that been factored consistently into the financial statements? Another thing with the sustainability report is that the government have said in their public policy statement that the sustainability report will be reported as within the annual report, and it will be subject to external assurance. However, that external assurance won't commence as reasonable assurance over the entire information. It's going to be a phased approach, recognising that it would be a big, it potentially would be a big impost on the profession. Is the profession ready to be able to provide assurance over the entire climate report? So it will be a phased approach to assurance. And the AASB is the body that will actually be determining how assurance is implemented, and what information will be subject to what type, what extent of assurance, whether it's limited assurance or reasonable assurance, and in what time frame. And so I'll just plug, we have just released a consultation paper last week. We are looking for feedback from stakeholders, so users, preparers, auditors, on what they think is an appropriate assurance phasing model, what type of information should be subject to assurance and when. Now, Eric, you asked whether there's any particular challenges with providing assurance over sustainability information. I think there is. It's always we hear constantly about the forward-looking nature of some of the disclosures and how that is a change in how auditors may gather audit evidence around those disclosures. So there are definitely some challenges. Definitely challenges around will entities have the systems, the processes, the controls, etc., around the data to enable them to prepare these disclosures and then for the disclosures to be assured. So there's definitely some challenges. The government's policy statement says the assurance over climate reporting under S1 and 2 will be provided by the financial statement auditor. Now, we're not quite sure that has not been legislated yet, but that is the position of the government in their policy statement. So that means you've got financial statement auditors who are whose career has all been around providing assurance over the financial statements will now be looking at climate disclosures. So climate disclosures. So they will need to be upskilled. So there's definitely, and they will use experts, etc. But there will be challenges in that as well.
Thanks, Anne. So anyone wants to respond to the consultation paper, please look at the AASB website for more information. Okay, so I have received quite a few questions from the audience, and the first question that I have is, do you think independent assurance over an entity's boundary and its sustainability information is important to stakeholders? And I thought the best person to ask this question would be Lou, from your investors' perspective. Do you think, from your perspective, Lou, independent assurance over an entity's boundary, is that, and also sustainability information, is that important to you? And what level of assurance would you like it to be?
I have to be careful to not be a hypocrite here, because we do get some assurance of our climate reporting, and we are only doing limited assurance of a couple of quantitative metrics, and that we're sort of happy with that. We've actually made a submission to the AASB on the mandatory reporting, and we're saying we should start with limited assurance and build towards a higher level of assurance in due course. And on that point that Anne made as well, the assurance work that we get done is by specialist teams within an accounting firm that sit outside of the sort of financial audit teams. That level of upskilling is certainly occurring at the accounting firms, and they're all too happy to volunteer not volunteer, charge a lot of money for their services in that regard. But in terms of what you're saying around boundary, I suppose I haven't really thought much about the specifics of the boundary in the different reporting. I guess the most important thing is that the frontier has been pushed out from just financial reporting to now, consider within boundary or within scope a lot of this sustainability data. But I don't think the boundary itself is something that needs to be audited. A lot of these things I think can be solved by common sense, but we may call it common sense, but it's often not that common.
Thanks, Louis. And is that the same what you have heard, and from other stakeholders too, or you have heard different things from other stakeholders?
Well, I suppose I haven't really thought about the boundary as such as either, but I suppose I see it as the auditor will be looking at the completeness and the consistency of disclosures in the financial statements and the sustainability report. So that will give some comfort around the boundary. And to Lou's comment before, yes, I think with the way that it will work, it'll be the financial statement auditor's firm, and then they will use definitely the firms are steady. If they don't already have climate sustainability practices, they're setting them up in preparation. So it won't just be the financial statement audit team or providing assurance over sustainability reports. They'll have to bring in climate experts and other sustainability experts, depending on what information they include in their sustainability report.
Thanks, Anne. Okay, so we're now going to the next question. Financial information is typically backwards looking, and sustainability information is typically forward looking. How clear are the connections that can be formed between this fundamentally different information without causing uncertainty and confusion? Perhaps Rebecca can help us with that question.
Yeah, I actually think it's a little bit of a misnomer that financial statements don't include forward-looking information. So I'm a property company. My company owns real estate assets. And when you value a real estate asset, it actually includes a lot of forward-looking information because you're applying discount rates and cap rates to, future expected cash flows. So when we're doing those valuations, there's already a component of sustainability related information that's included within the cash flows that are given to those valuers. So for example, if we have to go and do a major mechanical works upgrade, we're say up-speccing our air conditioners because we're expecting that the temperatures are only going to go up, then there'd be an additional cost to that capital works, and that would be included in those cash flows that would be given to that valuer, and that would impact that valuation. So I think that there is already in our financial statements a component of forward-looking information. If you look at a lot of the sustainability-related metrics, a lot of those can be backward-looking. So you're looking at, what's your carbon usage? How many tons of carbon has your organisation produced over a certain period of time? How much water, and so on. So I actually think that both financial and sustainability information contain a combination of forward and backward-looking information already.
Yeah, that's good observation. I think you're absolutely right. There are many forward-looking information in financial statements that entities need to consider. Okay, so now let's move on to the next question. At the moment, government business enterprises, GBE, are not captured in the first tranche of compulsory reporters. This is despite many of them reaching the normal thresholds that are applied to for-profit businesses. Interested in the panel's views on this, especially considering many of them are in the energy sector, which is a key to sustainable future for the planet. So what's saying here is that government business enterprises are not being captured, but I think the person who commented this sounds like implying that perhaps they should be considered for reporting, given that there's a huge amount of energy sector in the GBE. Perhaps Siva, can I pass this question to you?
Thanks, Eric. And I think it's again a good question, and I'll try my best to answer. I think this is also likely to be influenced by jurisdictional matters. For example, the Commonwealth's proposal. Obviously, different jurisdictions have different approaches. For example, Commonwealth's pushing down hard on this in some way, and some of the other jurisdictions are considering it. In terms of the consultation, or not the consultation, the proposals released by Commonwealth Treasury, for example, they are limited to certain entities. For example, those Corporations Act entities or captured by NGA reporting, etc. There are a lot of state-owned enterprises that if they are not corporations entities, they are not technically caught. For example, Commonwealth, as far as I understand, they don't have jurisdiction over state-owned enterprises, for example, if they are not corporations, act entities, etc. Having said that, the other related question is, in terms of public sector reporting, it is also a jurisdictional matter in terms of who reports to, because Commonwealth obviously has jurisdiction over for-profit entities and also Commonwealth enterprises. In terms of state entities, it is entirely up to the states to decide at what level that reporting takes place and when, and they will need to pass local legislation to mandate it within their mandate. The other thing to note is that within the public sector, there is a lot of discussion going on around this whole sustainability reporting piece as to how that should be rolled out. For example, a lot of water to go under the bridge as far as we are thinking in terms of rolling this out within the public sector, because there are different dynamics and different issues. For example, if I go to that comment around users, who are the key users of public sector sustainability reports or climate reports? In our context, for example, public sector entities don't normally go and get directly source their funding from outside. It's normally done by a central function. In our case, for example, in Victoria, we've got Treasury Corporation Victoria that centrally raises funds, and then it on lends to respective entities. So even some of the government enterprises, they don't have direct linkage between those, with the capital markets, for example, and that's done centrally. So there is a question around who are the direct users and at what level the reporting needs to take place. And also when you look at the whole public sector, it is a group. At the end of the day, the whole public sector is a group. Within that, each of these entities are more like divisions in some way. So there is a consideration, and a lot of the operations at the divisional or at the entity level is driven by central group policies. For example, individual entities within the public sector don't have a lot of discretion in terms of how they determine and how they manage climate risk, etc., because that's often influenced by central policies in terms of what cabinet wants to do, for example. So it is somewhat of a complex process, but the short answer is yes, I think they will be considered in due course, but it also depends on the legislative framework in terms of who is captured by the Commonwealth legislation versus who is captured by the state legislation, etc.
Thanks, Siva. Okay, next question. This question is related to for-profit Australian parent entities with New Zealand-based subsidiaries. The XRB's New Zealand SCS1 describes to report GHG emissions on an entity level and to disclose which organizational approach was used, whereas the draft Australian climate standards do not currently hold the same requirement. How do you see this regulatory standard mismatch being addressed for Australian parent entities? I guess to answer the question, so AASB has just closed its comment period for its exposure draft on the new climate standard. Staff is now analyzing the comment letters. I think this is what maybe one of the comments that the AASB staff may have received. So we'll have to wait until staff finish analyzing the comment letters and provide more information on that later. The next question, how does an entity report the right information to investors? Annual reports are too long already, and it's very difficult to find the information. Is there a way to clear the clutter? Okay, Rebecca, as a preparer, how do you make your annual reports much more readable?
I have to admit at the moment that I'm not really sure that we've solved that one here. Lou would probably be able to shed some light on what he thinks of my reports. But look, I think in the end, we're going to have to move to a system of XBRL reporting, which I think I've spoken about at some AASB functions before. It's really about how it is that you can search and find the information that you need in that document. And a tagging system like XBRL is probably the best answer for that. I think people sometimes misunderstand XBRL and thinking that you can only use it for data. In actual fact, you can use it for paragraph texts as well. So, if you had, the ability to go and search for a particular tag and take you to exactly the information that you need, the format of the actual financial reports, whilst it's still, good to have for someone who's probably leafing through it, for a targeted user who's looking for a specific piece of information, it's just going to make it so much easier for them. So I live in hope that Treasury will put that on their agenda and get the funding to go and have that implemented in Australia. I personally can't wait.
Thanks, Rebecca. Certainly, that's what we were hopeful for that too. Lou, do you have any insights when you read financial reports? How do you navigate long annual reports?
It's good that I've been at this for 30 years now, and so I generally know where to look, but I'm always suspicious that there's something buried deep in the notes that could be the great reveal. But thus far I haven't found anything. I do think that like I was always one of these old school people who wanted a nice tactile hard copy of things, but I do think that post-COVID and I didn't have access to a printer, I learned how to read things on screen. And I mean, I just use the old Control F function for the things that I'm looking for, and that goes a long way. But it is a big challenge trying to keep the sheer volume of content that an annual report is meant to cover to something that's digestible for a user. And I think companies, by and large, do the best they can with the front part of the report. The back half of the report, with all the financial information and disclosures that are required, sort of, creates itself. And I would, I would urge companies to put a bigger effort with their comms teams, and I'm sure a lot of them do this anyway, to just be, short and sharp with the messaging. One of the joys that I have now is to read in detail remuneration reports that are within a company's financial reporting, because you can imagine we have, significant engagement with directors of companies before their AGM, all wanting us to support their REM report. And those things can run to 20, sometimes 40 pages. And it takes me quite a while, and I know what I'm looking for, to just get out of it the things that I want to know. So, that could be something. It's not strictly within sustainability reporting. I think it's actually part of financial reporting. But there would be some certain principles, like it'd be good to know what is the maximum that the company gets, that the executives can get. What did they get this year in a summary form? Because then you go, the entrails of how that's all determined can take forever. But it's, part of why we're all in a job, I suppose, that, we have to read these things and make sense of them. But, it's fair to say that the company's approach to making their information more accessible does vary.
That's very helpful. Okay, so we're going to have the last question for the session. And the question is, does anyone have any experience or insights with boundaries and materiality for private companies with a handful of owners or even a single owner for reporting in this space? What are key considerations for climate disclosures here? Rebecca, I'm gonna pass this question to you.
Yeah, sure. Well, as I mentioned before, we have managed funds and we have mandates. So in actual fact, we manage certain entities on behalf of often a single or sometimes only two owners. And we do prepare financial statements and other information for those owners. I guess it kind of depends on the level of involvement that owner has with your business. So there are some hands-off managers, we manage their assets and they sort of leave us to manage. But often part of the pitch for getting that work has been around the sustainability information and the practices that we have internally. And so again, Lou might be able to speak to this because he's we do manage some assets on behalf of his entity. But I would imagine that they would want some comfort over, are we actually meeting the standards that we said that we would meet in that pitch. So from that perspective, the sustainability information that goes in the packs to those owners should really address that point. Now, I will say that it doesn't necessarily have to be in an annual financial report. It can be through other reporting mechanisms, because generally if they're a big owner, they will, put other reporting requirements onto you, which I think comes back to assurance around that, because auditors, would be very comfortable with assuring information that is required from a regulatory perspective. But if you're looking at assuring bespoke information for those owners, then, you're looking at a special engagement, and that can be a little bit more expensive. So
yeah, I was just going to echo that. Like with the unlisted assets that GPT manages for us, I'm sure our property team, often because they've been egged on by my ESG team, will make specific requests for those unlisted assets, and we find the companies quite cooperative. Obviously, the publicly listed companies have a separate regime that they report under. But it's worth making the point that we have a bunch of sort of sustainable and environmentally labelled investment options for our members, and part of that process is that we get them certified by the Responsible Investment Association of Australia, RIA, and that, you know, their requirements are becoming a little more onerous over time, and then we're just referring that pain back to our investee companies to ensure that you know, we have that data and can incorporate it into our assessment of things. Yeah, in a world of greenwashing, yeah, we can't go making spurious claims around how green our investments are without doing some due diligence around it.
Look, I can see we are a bit over time, and thank you so much for your input today. First of all, thank you, Jade and Lindy, to share your research and your insights. And I want to also thank you, Lou, Rebecca, Siva, and Anne, to share some really practical things over the conversation. So I'm aware that there are some questions that we haven't answered. Apologies for that. Hopefully, we will get back to you with those clarity in the future sessions. The slides and the webinar will be made available on the AASB website. Please look out for the news item that we do share with our stakeholders once a week. And with that, thank you everyone to attend the webinar. We'll see you next time in May. Thank you.